This country is facing a growing insurance crisis, and that's not an exaggeration. Homeowners policies are skyrocketing, especially in high-risk areas. This crisis is fueled by a combination of climate-related disasters, ongoing inflation, and insurance company withdrawals from certain markets. Consumer advocates, including our guests, also blame a lack of strong regulation and corporate greed. The insurance industry claims it's reacting to skyrocketing costs and trying to stay solvent.
We understand how unsettling it is to see insurance rates go up.
Loretta Waters is with the Insurance Information Institute, an industry trade group.
Insurance rates have to reflect the real risk of loss in order to ensure that insurers can meet their promise to pay claims when disaster strikes. We can't pay claims if we're not solvent.
I'm Herb Weisbaum, the Consumer Man, a contributing editor at checkbook.org.
Welcome to Consumerpedia at checkbook.org. We're the nonprofit that helps consumers select services, avoid trouble, and save money. Because we don't accept any advertising or take money from any business we recommend, you can rely on checkbook.org to be completely independent and objective. Now, here's the host of Consumerpedia, America's consumer expert, the Consumer Man, Herb Weisbaum.
In this episode, we're going to look at the home insurance market, where we are, possibly ways to make improvements, and what you can do to avoid some bad decisions as you try to lower your premiums. You'll also meet Rosanna, a homeowner in Pasadena. Her house is filled with toxic chemicals following the Eaton wildfires earlier this year. She feels betrayed and mistreated by her insurance company, State Farm.
I can't believe that they can market themselves as like a good neighbor. They're the worst neighbor possible. You pay for 30 years, and then when you have something that's no fault of your own, they will not live up to their promises.
We have two experts on the subject. Doug Heller is Director of Insurance at the Consumer Federation of America. Hi, Doug.
Hi, Herb.
And Carmen Balber, Executive Director of Consumer Watchdog. Consumer Watchdog is a nonpartisan group that works to give American consumers an effective voice during a time when special interests dominate public discourse, government, and politics.
Hi, Herb. Good to be here.
So I want to start with a look at a few data points, and these come from a recent report that Doug helped co-author for the Consumer Federation of America. From 2021 to 2024, annual insurance premiums for a typical American homeowner increased by an average of $648. That's a 24% increase. During that same time period, inflation rose by 11%. And in some states, the rate hikes last year were significantly higher. Utah, 59%, Illinois, 50%, Arizona, 48%, and Pennsylvania, 44%. And last year, the average premium for a homeowner with mid-range credit and a $350,000 replacement value policy was $3,300 per year, or $275 per month. Doug, when you saw those numbers, what did you think?
Well, we think that the stories that we've been hearing from homeowners all around the country are just the honest frustration of people who really can't afford to maintain the insurance that they need. And so many people are experiencing the kind of increases that you just described. And of course, we're looking at averages. For some people around the country, that premium is in the tens of thousands of dollars, especially in places like Florida and Louisiana and parts of California, but also parts of Nebraska and Oklahoma are facing these incredibly high insurance premiums. And if you want to have sustainable home ownership in America, you need to have a sustainable system of protection. Insurance used to be that, but it's no longer sustainable under the pressures that we've been facing. Just this summer, State Farm announced a 27% rate increase in Illinois. Illinois was already one of the states facing the highest increases. So all around the country, people are struggling to make payments on this critical but required insurance product.
Carmen, what are some of the real-life problems that you see related to skyrocketing insurance costs?
I can't tell you how many consumers we've heard from who are struggling to pay their everyday bills because of the skyrocketing cost of their insurance. That runs the gamut from homeowners who are being forced to reduce the amount of coverage. We hear from people who have been essentially priced out of their coverage and have had to fall back on state insurance of last resort, which is sometimes cheaper, but also covers much less. And we're hearing from consumers who are concerned they may not be able to pay their mortgage because their insurance cost is so high it's unsustainable. So it's really a baseline pocketbook problem for more and more Americans.
And you're also hearing in California from people who paid their premiums and can't get the insurance companies to pay their claims for the recent fires. What's with that?
I think that is the most fundamentally outrageous example of what these high prices are doing to people who have paid their premiums diligently for years and sometimes decades. In the wake of the Los Angeles fires, we saw a trend develop where consumers who had recently seen massive rate increases also learned that their insurance company was trying not to pay them for their full losses in the LA fires. So, for example, a coalition of fire survivors from the Eaton fire in Los Angeles got together and learned that the number one insurer who wasn't paying the claims they owed was State Farm in California. That company was simultaneously looking for a massive double-digit rate increase that amounts to about $1 billion every year for policyholders. So we have, on one hand, an insurance company looking for $1 billion a year increase in premiums, and at the same time lowballing insurance claims to the tune of 10, 20, or 30% of what insured people thought they were owed. An example of that, one of the worst examples, is consumers who suffered not a total loss of their home, but thought they were lucky that their home survived the fires, but they had smoke damage. Because, of course, when a fire burns, things melt, ash accumulates, all sorts of contaminants end up left in your home, and it needs to be, at a minimum, clean, but often elements of your home need to be replaced because the toxins seep in and they're permanent. And State Farm is one of the number one culprits, really lowballing those claims, refusing to pay for testing, and then offering consumers $30,000 when their private estimate is $150,000.
And that's exactly what happened to Rosanna Valverde and her husband Sam. They survived the Eaton fire in January, which destroyed more than 9,000 buildings. They were lucky, if you can call it that, because their house didn't burn. But it's filled with toxic chemicals left behind by all the smoke.
We have high levels of lead, arsenic, and nickel. And I was stunned.
Rosanna told me she and her husband have been living with their son since the fire because State Farm won't pay to make the house safe. When the appraiser and inspector for State Farm came to her house shortly after the fire, Rosanna told me, they concluded there was nothing more than smoke damage.
And they had one of those tall boxes of Kleenex, and he came in, he literally pulled one out in my entryway, wiped it on the wall with 2 fingers and said, "Oh, it's not bad. Do you have a cleaning lady?" And I go, "Are you insane?" And no, I don't have a cleaning lady. So then he went through the house poo-pooing everything as my husband and I are getting more and more upset and really kind of stunned by this. He said, "There's nothing bad here. You just basically need to vacuum it up and clean it up and that kind of thing." And I said, "Well, this guy from ServPro said we need to work with a certified industrial hygienist and we need to get it tested." And they said, "Oh, we never do that. Never." And the ServPro guy whispers in my ear, "They do it all the time."
But based on an independent appraisal, which Rosanna and Sam paid for themselves, the house is a toxic waste site. Everything must be removed, they were told, to detoxify the house.
It's called a pack out. Clean the whole house, clean the stuff off-site, and then bring it back so you don't cross-contaminate.
The attic insulation, carpets, and hardwood floors will go to the dump. Special paint will need to be applied to the sheetrock to lock in the heavy metals. The clothes can be cleaned. The upholstered furniture must be destroyed. Estimated cost? $300,000. State Farm settled the claim for about $70,000.
What am I supposed to do with that? You know, it's not even enough to start. So it still sits in the bank.
How would you describe how you've been treated by your insurance company, State Farm?
Disrespectfully, dishonestly, like we're stupid, and just dragging it on forever.
Now, Rosanna and Sam are considering the possibility of suing State Farm as others have done. As they see it, it could take a year or more to move back into their house. All the while, there are mortgage payments to make and property taxes to pay. All of this, Rosanna tells me, has taken a toll on the family.
We've been demoralized, defeated. We have panic attacks. We can't sleep. I've lost a lot of weight. We both have had to have medication for the panic attacks. I cannot believe these people sleep at night.
Checkbook wanted to know what State Farm had to say about this, but the company did not respond to our multiple emails. Rosanna told me she wasn't surprised, considering how she was treated. Doug, I know you're not surprised either.
This is not just a problem that we're seeing in the wake of these fires in California. A few years ago, the Washington Post did an investigative reporting and found in the wake of Hurricane Ian, which devastated Florida, after the insurance companies would send their adjusters out to look at the homes and come up with a cost of repair, the insurance company executives or higher ups would look at those adjuster claims amounts and then send it back to be changed and reduced, such that so many of the homeowners with legitimate claims in the wake of that hurricane, they found that their original claim that was supposed to be paid at about $100,000 would be reduced dramatically, oftentimes below their deductible threshold. So people with serious damage and the insurance company's adjusters having told them that they should get paid $100,000 for repair costs were suddenly getting nothing. This is a practice that the insurance industry uses in the wake of catastrophes in California with the wildfires, in the wake of the hurricanes, but also when people report hail damage after a severe thunderstorm around the country. We see this time and again where the insurers who sell us this product with a contract to pay come up with excuses not to pay. Win-win for them. But homeowners around the country are paying for a product they're required to have and that they need to secure their home, and yet aren't getting the benefits of what they paid for.
Really good point. This is a national problem. Carmen, I just want to go back one last thing in California. You talked about the emergency interim rate hike that the state granted State Farm in June, 17% for homeowners, 15% for renters and condos, 38% for rental dwellings. The company said it needed to rebuild its capital after the wildfires in Los Angeles County earlier this year. Your group opposed the rate hike. You said State Farm had not adequately proven the need for the increases. So why in the world is the state of California approving this?
Unfortunately, the department went against our arguments, and that interim emergency request that State Farm asked for was approved. However, ultimately, the company did not explain or justify the reasons behind that increase. That interim increase is now up for review, and the company has asked for even more money. Essentially, State Farm is now asking to increase the interim rate increase they got to 30% for homeowners. And that will amount to more than $1 billion increase annually for State Farm policyholders. The company is claiming poverty, but the facts say otherwise. State Farm's parent company, which, by the way, is really on the hook for most of the LA wildfire losses, has $140 billion in the bank in surplus funds that it could be using to, one, make California homeowners whole in the wake of the LA fires and stave off the supposed financial emergency that its local subsidiary is in. So State Farm crying poverty is a real joke, and it's a real slap in the face to California homeowners who have paid them for years and are now not getting their claims paid.
I keep hearing the jingle in my head, like a good neighbor. Anyway, Doug, will the high cost of insurance, something, as you said, is being experienced all across the country, is that going to price people out of buying homes or condos, or maybe keep builders from building, affect landlords? Is this going to have a whole effect on the housing in this country?
I'll tell you, I'm hearing from realtors, developers, people who build affordable housing, and they're freaking out. They don't see a way out of this at these prices, because if people can't afford homes, people aren't going to build them. And that creates an economic cycle that can be really just tremendously painful for our whole economy. We are seeing already a significant and concerning rise in people who are going uninsured. So to go uninsured, you own your home outright. It's very dangerous to do that. The people who are going uninsured are not doing so because they have enough money in the bank in case something terrible happens. They're going uninsured because they can't afford the coverage. And right now, we estimate there's about $1.6 trillion in market value of homes that are uninsured. We have a real crisis on our hands. I think that this is going to affect a whole range of aspects of our economy, including, as you suggest, the housing market.
$1.6 trillion of uninsured property in this country. That's a lot of folks who, if something happens, the worst happens, they're on their own.
Yeah, that's right, Herb. And we do see concentrations in some cities, Miami, Houston, Detroit. So if those places sustain catastrophic kind of weather-related events, you can imagine that it's not just going to be all those individuals who are dealing with it, but you'll see community blight when you can't rebuild. And so there are two things happening, both the individuals, the families who are exposed to losing everything because of this insurance crisis of ever escalating prices and lower quality coverage, but also communities losing so much. It's just utterly clear that we have to take this seriously and engage in public policy changes to address the problems.
And there's one more dynamic going on here. Homeowners who live in hard-hit areas such as California, Florida, North Carolina, where some of the insurance companies have decided not to issue new policies and not to renew existing ones, that's leaving these folks with few or no options.
Yeah, that's right. The market is not working. And I think that we tend to assume that, every market is a perfectly free market and, we just have to go and the supply and demand curves will match at some point. But the reality is, on the demand side, us consumers, we're required to buy insurance by our lenders. So we always have to buy. So the insurance companies have incredible amounts of power. That's why we're seeing around the country these regulators just kind of fall in line whenever the insurance companies make a demand because the companies have so much power. We really are facing a market for which the unregulated environment that we rely on in so many other types of markets just isn't working. And it just reminds us how important it is that we take the regulation of this industry more seriously than we have, because we've been letting the industry try to solve the problem and they've failed us. I hear so many times the insurance companies and their lobbyists say, well, it's so hard to be in this business. Why would anybody want to be in this business? And I think at a certain point, if the insurance industry keeps on telling us they don't want to serve our communities, we should take them seriously. We should believe them and start thinking about alternative ways to make sure that Americans can protect their homes and secure home ownership.
And that's what we're going to talk about next, the influence that the insurance industry has on lobbying state lawmakers and regulators, and how does the little guy deal with that? I'm Herb Weisbaum, the Consumer Man, and you're listening to Consumerpedia, powered by checkbook.org.
At checkbook.org, we have the answers to your consumer questions 24/7. That's checkbook.org. We're a unique nonprofit that can help you with select local service providers, avoid trouble, and save money. Because we don't accept any advertising or take money from any business we recommend, you can rely on Checkbook to be completely independent and objective. Our advice is always free. Ratings of local services are available with a subscription. If you live in one of these 7 metro areas and haven't joined Checkbook yet, check us out. Boston, Chicago, Philadelphia, Seattle, San Francisco, Minneapolis, St. Paul, and Washington, D.C. Get your free 30-day subscription by going to checkbook.org/consumerpedia.
Insurance is primarily regulated at the state level, and insurance companies have a lot of clout with state lawmakers and regulators. Their influence stems from a mix of political spending, lobbying power, and their perceived importance to the economy. So, Doug, how influential is the insurance lobby in this country today?
It's an incredibly powerful lobby. They work every state house in the country and every department of insurance in the country every day. And they are huge contributors to the campaigns of politicians. And they also just have a legion of lawyers and lobbyists who show up advocating for their own interests. And the rest of us consumers, we're just trying to get by. We don't have the kind of resources to be there every day. So what happens is the insurance industry becomes so close with the insurance regulators that you have that classic fox guarding the hen house. And we see this play out all around the country with premiums that are too high, with claims practices that are unfair, and with a market that is not meeting the needs of American consumers. And it stems from the incredible power that the insurance industry has in every state house.
Carmen, what do you see when you try to work with state insurance commissioners?
Everything Doug has said here is true. And it factors into the fact that we're so often in a situation where the insurance companies' excuses for their behavior become accepted as the baseline reality. And I think a perfect example of that is what we're going through right now, where the insurance industry points to climate change as the excuse for all abuses. Prices are going up because climate change, we can't help it. We aren't paying claims out because climate makes those things completely uncoverable. We have to exclude them from your policy. Or we can't cover whole swaths of your neighborhood or your state because climate change makes that place uninsurable. But what regulators need to do, and often don't, is remember that the insurance industry is looking at their very short-term profits. Their goal is not keeping your community or your state insurable, that their goal is their 6-month or year-end profitability and how they can shift where they do and do not cover in order to maximize that profitability. And if that means dropping some of the, yes, riskier, but not uninsurable homeowners in order to pad their bottom line, they're going to do that, which is why that industry influence over regulators is one of the reasons it's so troubling, because that makes the industry narrative where they start the negotiations.
If we were talking about a product that wasn't critical to our lives, that wasn't required for us, maybe you could let prices go up and people would just decide not to buy it. But when people don't buy home insurance, they're putting the most important financial asset in their lives at risk.
Yeah, let me just add to that, because I think it's a really important, perhaps positive development with the pressures of non-renewals and rising costs in the home insurance market, making more and more people unable to afford their coverage or unable to get it at all. Grassroots anger at the insurance industry is really growing at a phenomenal rate. And what that means is constituent anger is in some cases overwhelming lobbying power of the insurance industry to actually implement changes in state legislatures that perhaps because of the power of the industry in the past were impossible. But as more and more people are either priced out or squeezed to the breaking point by their insurance costs, the possibility of reform in legislatures that have often been captured, I think, is increasing.
Well, clearly insurance rates are already more than some families can afford. So the question is, how are we as a country going to deal with this, and what can you do to get the most for your premium dollar? That's straight ahead. I'm Herb Weisbaum, the Consumer Man, and this is Consumerpedia, powered by checkbook.org.
Consumerpedia Fast Facts. The concept of homeowners insurance began hundreds of years ago, but according to the Insurance Information Institute, the first modern multi-peril policy was written in 1950. It included coverage for fire, theft, liability, and more in a single package. According to Money Geek, property damage resulting from extreme weather, primarily wind and hail, is the most common reason for homeowners' claims, followed by water damage and freezing, and then fire and lightning. Fire and lightning are the most expensive claims, averaging nearly $84,000 per incident.
According to a recent report from the Federal Reserve, 7% of the homeowners in this country didn't have homeowners insurance last year. 19% said it wasn't worth the cost. 43% said they couldn't afford a policy. Doug, all this creates an opportunity for some predatory practices that homeowners need to watch out for.
You're absolutely right. And we're really concerned about what we're seeing in the market. So there have been some changes over the last couple of years in which insurance companies are really hollowing out the policies. They're offering slightly lower prices for a product that really can't be recommended. So one of the things that we urge people to look out for when they're being told, hey, well, I can give you a discount, is a policy called an actual cash value policy. Typically, when we buy insurance, we're looking for replacement costs. So if our roof were to be blown off, the insurance company would put a new roof on our house. We'd have to pay our deductible still, but they would pay for the rest. Under these actual cash value policies, the insurance company is going to use a depreciation factor on the value of your roof. So if you had a 15-year-old roof that wasn't leaking, that was working perfectly, that was blown off, instead of them paying for the whole repair of the roof, they would depreciate that. And a 15-year depreciation on a roof, which maybe is graded for 20 or 25 years, means you're going to get almost nothing, certainly a very small percentage of what you need, which leaves you having to rebuild your roof almost by yourself. Completely undermines the purpose of insurance, but it's the way insurance companies are trying to pitch people on a product which is just getting too expensive for them. So I want people to make sure they ask any agent or insurance company if this is an actual cash value policy or if it's doing what they would expect, which is replacing with the replacement cost value. So that's one thing. We are seeing companies push higher and higher deductibles. You have to remember that if you have a higher deductible, you're taking some of that risk of loss back onto your own wallet, and you need to make sure that you're going to have enough money in hand. So we want to be careful of that. And then there's one other thing we're seeing grow that's really concerning, and it's the growth of so-called surplus lines or non-admitted insurers. These are insurance companies that aren't regulated by the state. They'll sell you a homeowner's insurance product, but nobody in government, no regulator is looking at the contract that they're giving you, the policy. They're not looking at the rates they're charging you. So you could be paying too much. You could be getting a product that is insufficient. And then most importantly, unlike most of the insurance companies that we buy from now, these non-admitted insurance companies, they don't participate in what's called the guarantee fund of the state. That's the system that ensures if one insurance company goes belly up and can't pay their claims, the rest of the insurance market will pay the claims for them. It means that we can trust that our policy will be there if a disaster puts our insurance company out of business. But with these non-admitted companies, they're not part of that system. And if they go belly up, there is nobody to pay our claims. So we want people to be very careful about the product that they're buying and the company they're buying it from. Make sure that you know that you're getting the replacement cost that you need, and you're getting it from a company that is licensed and admitted to do business in the state, so you're getting the kind of protection you expect.
If you're not sure, check with the insurance commissioner's office and make sure that company is licensed to do business in your state. Carmen, anything you want to share based on your experience dealing with all the problems you see?
I mean, there's two conflicting problems here for consumers. One, you want to make sure your home insurance policy will actually make you whole. But two, you want to figure out how to make it as affordable as possible. On the affordability side, it's almost a rote answer, but we have to give it every time. And that is, you can always try shopping around. In some markets, that's harder than others, but it is always worth seeking out other companies to see if you can get a better deal elsewhere, because they're all targeting different people. That can be harder in the home insurance market. So we often recommend folks seek out a broker who might want your new business and help you look around at different companies you might not be thinking about. So that shopping around is important, even though it can be frustrating, very time consuming. And then on the flip side, one thing that we're seeing more and more of across the country is people being underinsured. So they think they avoided that actual cost value trap that Doug was talking about. They bought a replacement value coverage policy, but that replacement value coverage lowballed the actual cost of rebuilding their home, because insurance companies are using standard algorithms across the country to estimate what it might cost to rebuild your home. And those algorithms are underestimating that cost. So one thing we urge consumers to do is confirm with their agent that they know the details of the home that they live in. Make sure they have all of the specifications of your home, and that, the form wasn't, for example, autofilled with the wrong information, because that has left a lot of folks in the wake of some of these Los Angeles, Northern California, other fires here in California, finding out too late that they were insured for up to $500,000 when a rebuild is really going to cost $750,000.
Well, we've covered a lot of ground here, but just scratched the surface. So I'm going to put links to much more information in the show notes for everybody listening. Want to thank our guest, Doug Heller. He is Director of Insurance at the Consumer Federation of America. Doug, is there a website where people can go to find more information about insurance issues?
Absolutely. We always love people to visit consumerfed.org.
And Carmen Balber is Executive Director of Consumer Watchdog. Carmen, it was great to talk to you. Where do folks reach you?
Come to consumerwatchdog.org.
Individual complaints, can they contact you as well?
Absolutely. We are collecting complaints, trying to both help folks out where we can and tell their stories when we can't, so we can drive policy change.
Well, that was a fascinating discussion. Before we go, a related Consumerpedia episode you might want to check out. Number 40, Insuring Your Home. It's loaded with tips and advice on buying homeowners insurance. We found that it's possible to save $1,000 or more a year simply by shopping around. And with that, we've come to the end of another episode. We hope you'll rate this and follow us on Apple Podcasts, Spotify, or wherever you listen to your podcasts. And remember, we release new episodes every other Thursday. Another way you can support this show is to follow us at Consumerpedia on Facebook and Instagram, at consumerpedia.org on Blue Sky, and at My Consumerpedia on X. You'll find me at consumerman.com. I'm Herb Weisbaum, always looking out for you. Until next time, be smart and shop wisely.
Consumerpedia is a public service of checkbook.org. We're a unique nonprofit that helps you save money and make smarter choices. You can count on Checkbook to help you find the best services and avoid the worst, with local ratings that are accurate and unbiased. If you live in or around these 7 cities and haven't joined Checkbook yet, check us out. Boston, Chicago, Philadelphia, Minneapolis-St. Paul, Seattle, San Francisco, and Washington, D.C. To get your free 30-day subscription, go to checkbook.org/Consumerpedia. Consumerpedia, empowering consumers to save money and make smarter choices.